So, guys, welcome to episode four of the 100 Days in Finance Challenge, the Investors Lens series. This is episode four. We're here with Lucimadio. Lucimadio has been our speaker on this topic about investing, especially from the perspective of an investor, a young investor, instead of a young person looking for investors. So, Lucimadio, welcome so much. This is high energy. High pace, high pace, high pace, too much energy, too much energy, too much energy. Welcome so much. We're really glad for you to give us your time today. So welcome so much, bro.
You're welcome, brother. You're welcome. It's good to be here again.
Thank you, bro. So today's topic is actually risk as a strategy. Diversification beyond stocks and bonds. When I say diversification, I mean putting your eggs in more than one basket. I think that's as simply as you can put it. And I think the first question goes without saying. What is your interpretation of risk, Lucimadio, as far as an investor is concerned? What is your interpretation of risk? And how can you use that risk as a strategy? I guess that's question one. Yeah.
Okay, I mean the risk. What is risk? Risk. I mean, from different people, from different culture, from different background, risk will mean different things. For us as Africans, risk is anything that will kill us. We have that mindset as Africans that anything that has a word risk to it or attached to it, it's something that's gonna kill us.
Yeah.
That's why in terms of taking risks in Africa, it's still something that not many people are willing to do it. But we have learned that countries like China, for example, they understand risk as an opportunity that is locked, ready to be unlocked. That's what they're looking to.
Yeah.
So we understand risk in many different ways. And for me personally, I do see risk as, yes, it's something dangerous to be part of or to get involved in. Yes, it is. However, risk hides the face of an opportunity that could benefit you in a long term. And that is how I view risk in my age. And I think also the view of risk in some societies, it is very relative to certain things, like, for example, your academic level, for example. The more academic you are, the more intelligent you are, the higher risks you take. Okay, the more knowledgeable about something you are, the higher risks you take. Okay, so usually people who do not take risk are usually people who have very little understanding about the aspect of things, because they do not know about what is happening. They're not able to predict a possible consequence. They have very little understanding, and that becomes a barrier for them to take risks. And that's the same. That's what applies with people on the other side. Like, for people to be able to take risks, it requires them to get to know about the actual risk, what the actual risk entails. In investing space, we say that you take calculated risks that you can manage. And that's why even in the investment, in the Forex exchange space, they say only trade with the money that you are willing to lose. You get what I'm saying?
Yeah.
So these are ways to tell you that you need to take a risk, but take calculated risk. Something that you cannot, like if you're not making it, you can always go home and have a nice food and sleep in peace. You know, yeah. So that is basically what I would say when it comes to understanding risk. It's about the level of your knowledge, how much you know about the risk. Will actually be the influence to dictate if you are going to take risk or you are someone who takes risks or not. Because risk is everywhere, even on the smallest thing. Even when you leave your house to go to work, you're taking a risk because you never know if you're going to come back home. Okay? So those are risks. So we just have to be able to be knowledgeable enough to actually accept to take risks. Because you know when you get out, you know exactly what happens.
I think now when you say now risk as a strategy now from like an investor's perspective, let's start before we actually even talk about diversification. Let's talk about risk as a strategy in terms of stocks and bonds. How is investing in stocks and bonds risk averse? Is it managing risk so that in case other things go bad, you can always rely on the former or the latter to mitigate those losses?
I mean, the first thing you must know when it comes to this is understanding exactly what is it that you call bond? What is it that you call a stock? You get what I'm saying? So understanding that aspect, I think it's very, very crucial because some people don't have a proper understanding of what a bond is, right? So if you don't understand what a bond is, it means you're never going to like accept to take that much of risk. Okay, you're never going to invest in bonds because you don't understand what a bond means. And also the same idea. If you don't understand what a stock is, you're also never going to accept to invest in it. So there's many things. That's why I say in the beginning, understanding the actual environment is the major factor for people to take risks or not take risks. So now, let me give you guys like a little background about what bond is and what stock is, right? A bond is, let me put it this way, a very simple way. A bond is when you invest in a bank. Okay, you're investing your money in a bank, right? So, in other words, you take your money and you go to a bank and you say, I want to invest my money in this bank. How much interest are you guys giving me? And then they say, if you invest in our bank, we give you in the space of 10 years, you get like 5%. I'm just giving an example, 5% interest rate from your investment, right? So you don't care. It's not your problem where your money goes. It's not your problem where the bank invests your money into, right? So the bank works with other businesses, other organizations like your pension bonds, and if bank also works with stock exchange. Bank also works with other investment organizations. So they take your money and then they invest in those places, in places where they feel like could be great for your investment, for the return that they're looking for. And then in return for using your money to invest, they give you 5% on top of your money. Okay, that's what bond means.
It's sort of like giving somebody a loan. It's
correct. That's it.
Oh,
that's it.
So you give them a loan, and then they give you a repayment period where you gain interest on the amount you actually gave them until now they pay back the original amount.
Yeah, correct. Well, it's like, well, that is with the loan is a bit different, because with a loan, if you're loaning someone, you are getting your money and with the interest in the space of time, right? And maybe the person is paying that loan monthly until the loan is done, correct?
Yeah.
So
Yeah.
you're not operating as a bank. You're not a bank, and that I wouldn't call that as dealing with in bonds, because you are basically giving someone money to use for their own things, and then they give you the return, right? But
Yeah.
it is a much formal, this word formal of investing in bonds is way more utilized when you're investing in a bank, when you're investing through a bank, because then the bank will then do that for you,
Yeah.
right? And you may be finding as well other organizations where you want to invest in that are into bonds, like mutual funds, your wealth management organization, you know, your private equities, your, yeah, all these investment organizations that are out there that are investing into bonds or mutual funds. Then you put your money in there, and then they invest into those opportunities, right? And on other way, and on the other side, these bonds are actually given by the government. Okay, so the government is the one who issues these bonds. So you basically, when you are investing in bond, is basically you giving your money, you are borrowing, you're giving, you're loaning your money to the government so that the government can use it for public service or invest it into potential bonds, and then you get a return in a percentage that you know that you agree. So most of these things are happening between private sector and the banks, or like private individuals and banks, and then the banks take that money and then invest that money into anything that they want. That includes bonds. So, but the process of bonds is basically just as simple as that, as you giving your money to a government or to a company for them to use it for whatever they want to do, and then they give you your money back with a specific interest. That's what bond is. But now, when it comes to stock is you buying a share from a company. So that's what the difference. Okay.
Oh,
So
so now bonds is, it's sort of like loaning, but stocks is sort of like buying to own, but in the bonds you don't really own. You just it's like leasing. They're leasing your money.
well, I wouldn't use the word leasing on this aspect,
Okay.
because it's very easy to understand here, right? It's like bond or bonding. It means you are giving your money to a bank or to a government, like to a private company or to a government, for them to use your money, so that at the end of the day you get your money back with the interest. Okay.
Yeah.
So there's a fixed interest. There is everything is stipulated according to the law. Your money, you only get your money once the money is attained to that level, right?
Yeah.
That's why I gave an example of bank, because we, like, if for example you are going to a bank and you're investing in a bank, you agree on a fixed interest rate, and then you only get your money once your money attains that period of time and that amount of money, or based on the interest rate. That's the only time you can request for the money, you know.
Yeah.
Another very, very, very popular example is when people invest into closed accounts, for example, like your accounts that you cannot open for a specific time, right? So, and another example of that is a saving account. Okay, so yes, a saving account is an investment account. It's bond.
Yeah.
Okay, it falls under bond. So your saving account, because your saving account.
Bonds take on different names in different forms, but if the concept still remains, it's still a bond.
The concept is the same. The concept is the same. So let me give you an example. Which, like, for example, between your current account, because in the banking system you have current account, saving accounts, and many other different accounts, right? Credit account, debit, and all these things. Now, let me tell you this. Which of the between saving, credit, and current account, which one do you think the bank uses your money to invest in other opportunities? Which money which account do you think they use the money from?
The savings, because that's what you
Correct.
won't touch it.
Correct.
Yeah.
They take when you have, that's why it's like when you open a bank account, you can have a saving account, a credit account, and then you have your how do you call it, your current account. Why? Your current account is what you use every day, so they can't just take that money. You use that money every day because that money cannot stay there. It is a money for you to continuously use it for daily things. That's why they call it a current account. It's always active, so that money is there for you. But the savings account is the money where you always feeding it with money. You're always feeding it because you're keeping it for a specific time, right? But now in that saving account, what happens is that there is an interest rate that you get because your money grows as it goes. Okay. Yes. So your money, the longer you keep your money on the saving accounts, the higher it gets to be because there is an interest in it. There's an interest rate that you put in there. That's basically like an investment account, but you just call it saving. Okay, you keep the money there, and there is a very thin interest rate that you get when you have your money on the saving account. But then that's the money which they use. The bank uses it to lend to other people. Okay, right. And now then you have your credit account. Your credit account is the account which the bank uses other people's money to lend to you.
Oh, that makes sense.
Do you see that?
So now you have the three: the savings, credit, and current. Current is what you use on a daily basis. Credit is what the bank uses other people's money to lend you, and savings is savings is what they use to lend other people money.
Correct. You see you see how bank works. It's a circle there, right? So you as an investor, you have got to have that mindset. You have got to understand this part of the game, because when you are putting your money in the bank on the saving account, that's the money that the bank uses to lend to other people and to invest into other things, right? Then the credit account is your account which you are lended money from the bank. That the bank takes that money from other people's account and they give it to you because they know they are gonna get that money back. You understand? Correct. And you get it with interest because they're lending you money. There's an interest on using a credit card. There's an interest there.
There's always an interest. Yeah.
You get what I'm saying? Now, the other thing is that is why it's advisable as a person, get a current account, because the current account will allow you to use your money like there is not much of interest there. They can't just use it. They can't just take that money from the current account because that's your money of every day. Okay, that's your money of every day. So but then they come up to you with another lie of investment account. So all those kind of things are just lies and ways of making you put as much money into different accounts that they can take and use for their own things. But now, that's the point. That's the point of understanding how bond works. Bond simply, it's a very easy concept of bond. It is you taking your money and you lend it. You give that money out to government or to a company for them to use it, and then they give you your money plus interest, according to how you're going to agree, specific time and the interest. But now a stock You are not lending money. You are buying a share from a company. You are owning the company.
Owning. So you have a piece of ownership into,
Yes,
like, let's
yes,
say,
that's what it is.
yeah. So
Okay, that's
actually,
what it is.
now, like, I think when people there are actually levels to stocks. I don't want to get too much into the details, but now since we're going into stock, now can you like explain to people this simply, because now I think me I've finally understood the difference between credit account, how a credit account works, savings account works, and then now I think you should also simply show people what exactly a stock means, and what a stock entails. Yeah, yeah.
I mean, what is stock? Stock is what? Stock is it's just a terminology it's just a term that we use to specify or to tell you that you own a share or a part of a company. That's what we call stock. Okay, when you buy a share of a company, automatically you own a stock. Okay,
Stock.
it's the same thing as you use the word stock exchange or you. Inventory. You know, when it comes to inventory management, there's a word we use to identify or to say that we have enough product in the warehouse. We use the word there is stock, right? There is stock. So that means we have something to sell. We have something that you can pay for, that you can own, right? That's basically what that word means. Like you say, stock. Stock is what? Is what you own. Is what you have. You own a stock. You own. You have bought a share. Therefore, you own a stock. That's what it is. Okay. So you own. You. It's like you bought. You buy a share. Therefore, you own a stock.
Yeah. You buy a share, so you own a piece of what makes the whole company. You own now a piece.
You own a piece. I mean, if you say you own a piece, you are bringing it. You are trying to reduce it to a one thing. I want you to look it from a perspective, from a global perspective, from a general perspective. Like if you buy a share, you buy a share. You don't own a share. You buy a share, but you own a stock.
You own a stock. Oh, you buy a share. You buy a share and own.
So you buy a share, you own a stock. You don't own a share. You own the stock. You bought the share.
Bought the share. Oh, okay. Okay.
So I'm just trying to make it very clear in terms of language here, right?
Yeah.
Because someone will say, "Oh, I own a share of this company." No, you don't own a share. You bought the share, but you own. People usually say that I own a share of this company. You don't own a share. You buy a share. Okay, you buy a share. Okay, but what you own is a stock within that company. Okay, let me give you an example.
Yeah.
Let's say you go to Coca-Cola, right? And then you say, Coca-Cola, I want to buy a share of your company. Okay.
Yes.
So in that specific share that you are buying, you're gonna buy a share. It's like you are getting a part of the company. Okay.
Yeah.
You're getting a part from not the company on its own. Okay. There's a difference between a share and owning an equity. Okay. A company share and a company equity are two different things. Okay.
Oh, company. Okay. A company share and company equity. Yeah. Okay.
Let me put it this
With
way,
this.
because I know it sounds a bit complicated. So here you have stock, equity, and shares. Three things. Okay. And I want everybody who's going to follow us to understand this thing very well. Like, it's conceptual. That sometimes people misunderstand these things.
Yeah.
You have share, you have equity, you have a stock. Okay. So now,
Stock, equity, and shares.
the difference is this. The difference is the following. You buy a share, you own a stock, but you are given equity.
You buy, given
You buy a share,
equity,
you own a stock,
buy.
but you are given equity.
So, so does this mean the moment you buy a share, you own a stock, so that the company gives you the equity? Is it the same?
Yeah. I think you are getting there. So that is that thin, it's a thin line around there.
Yeah.
Okay. But now, when it comes to stock, to buying stock, I mean, to owning a stock or buying shares, you need to understand something. There's a difference between a formal or a proper certified shareholder and a shareholder that bought the shares in an app, like, in a stock market. It's two different things. Okay, you're not the same.
Yeah. Okay.
Okay, you who bought, let me put it this way, you who bought the shares inside an app, inside a trading app, and the person who have got the certificate of a shareholder of a company, you are not the same.
What's the difference?
The difference is that, number one, a person who has a certificate of a shareholder, number one, that person, he has a voting power in the company. You don't have it because you bought the shares from an app. You bought the share from the stock market. You grabbed it from the stock market. No matter how many shares you have, you bought it from the stock market. That is very, very different from having a one-on-one discussion with the board of directors of a company and actually buying shares, from a private setting. You understand? So that's a very privileged level of community. For you to get there, it means you are putting a lot of money in the company, right? So this is the reason why there's a difference between buying a private share and buying a share from a initial public offer. Because someone who buys a share from initial public offer, he is buying from the market. He's buying from the stock market, okay? But someone who's buying a private share, he's buying on one-on-one discussion with the owners of the company, with the board of directors of the company, and he is buying a shares of a company to own a stock, and the company gives that person an equity.
So that means owning a stock does not necessarily give you equity in a company.
Yes, not necessarily. Not necessarily.
But if you buy a share, you can definitely own a stock.
Yes, if you buy a share of a company, you can own a stock. I mean, you can be given an equity. Okay, you can be given an equity if you're buying a share of a company. But now the difference here
mean that you will be.
Yes, I wanted to get me properly. I want to get me very well. This is a bit technical, but let me break it down.
Yeah.
See, buying a share is everywhere, is where everything starts when you buy a share. Okay? So now, buying a share can either lead you to have a stock or to own a stock, or to go beyond that, which is to be given an equity. Okay? So now, when I say buying a share, you're buying a share from the profits that the company makes. Okay? From the profit the company makes, you have a share on the profit. I will repeat, you have a share on the profit that the company makes. Okay? Number two, when you buy a share and you now have a profit from what the company makes, you now can say, I own a stock. Why? Because the money which you gain, it is based on the number of stocks that you own.
So the share of the profit you gain depends on the number of stocks that you own.
Yes, yes.
Okay.
The shares in profit that you receive every single month from that investment is based on the stock that you own. Okay. The more stocks you own, the more your profits are, your share is, or your share value is.
But you owning a stock does not necessarily give you equity in the company.
Correct. Yes, it doesn't give you equity.
I think you have to break down now what exactly equity means as compared to the stock and the share. Yeah, because that's
okay. Okay, so now what is it that leads to equity? Okay, what is that leads to equity? What leads to equity? Usually, companies give out equity in. And I'll put it two stages. Two stages. The first stage is on when the company is starting. Okay, when the company is starting, you give yourselves equity. Like as the founders of the company, you're gonna give yourself equity. So that equity, you give it in a form of ratio. So like a 20% equity. If you are like two founders, you're gonna say each of you have a 50% equity of the company. That is way beyond, like, beyond just owning a stock. That means it's you owning the actual company. You're owning the actual company. Okay? So owning a stock and owning a company, two different things. Some people can own a stock or have a share or buy shares,
but never own
but
the company.
still don't own the company.
Oh. Okay.
Okay? So that means that you don't have a say in the company. You can't talk. You can't. You just wait for your money end of the month. You don't have a say. Yeah. So for someone to have a say in the company, you need to own the company. You need to own a piece of the company. And that's where equity comes in. So owning a equity, it means you own the company. You own a piece of the company. Okay? There's plenty of definitions outside there that people will put, like stock as own a company. No. If you own a stock, it doesn't necessarily mean you own a company. You just own an amount of stock that actually produces the share that you have bought. Okay? It's like,
so it's like a return, it's like a return on investment.
It's an investment. Yes, it's an investment.
But equity, but once you're given equity, it's more of controlling your investment.
It's a controlling power. Yes, it's a controlling power. But it's not the controlling power of your investment. It's a controlling power of the company on its own. You now have a voting power. You now may be classified as a certified shareholder of the company, right? And this stage, as I say, the first stage is when the company is starting, as the company is being founded. You can all each other as founders do what we call share equities, give up the equities to each other. So each person owns the company, not just the shares, not just the stock, not just the profit. You own the company, right? That's one. Number two level of where companies give out equities or give equities to investors is when they are going to raise funds for the company. Okay, so when they are going out to raise funds, like your investment, Series A, Series B, raising funds or startup, so when they do that, that's also another time where they give out equity.
Yeah.
They're basically giving that person, that investor, the ability to have a control or to have a say in the company.
Oh.
But in exchange of money.
Yeah.
Okay.
That must be a lot of money then. If let's
It
say,
depends on how much the investment you need. It's not like it should be a
yeah,
lot, but it depends on how much you need. Like
yeah,
a very basic example, what we normally see is like your drunk was 10, all these TV series, reality shows for investment. What
yeah,
simple thing. An investor is there sitting there with money, and then the guy
yeah,
comes in and said, I am asking for 5% of my I'm giving out 5% equity. Or it would
equity.
say, I'm giving out 5% shares. I'm selling 5% shares, or I'm giving out 5% equity. The language is different.
The language
Okay?
is
Language
different.
is different.
Yeah. So that means like if you don't want to give out a piece of let's say your
We have an
company,
equity.
let's say you don't want to give out like a piece of your company, you say I am selling 10% of my shares or stock.
Yeah, I am selling 10% shares of my company
Yeah.
for a specific amount of money. That's all. So when
Yeah.
now the person comes in and pays for that shares, automatically that person owns a stock, okay, owns the stock in your company. So that's why
Yeah.
it is directed, like buying a share is directly proportional or is directly relational to ownership of stocks, okay, of a
Yeah.
stock. So once you buy a share, you own a stock. But that
Yeah.
doesn't mean that automatically when you own a stock, then you have a say in a company. You don't. Okay? You don't have a say in a company
Yeah.
just because you own a stock or because you bought a share. You have a say in a company or in your investment when you own or you are given an equity. It's a
Equity.
company that gives it to you. When the
Yeah.
company gives you equity shares, equity in the company, that's when you now start
That's
having a
right.
power in the company. But for you to get that level, you need to have a certificate of a shareholder. It's legal shareholder in the company. So now many
So,
people, yeah,
so,
many
so,
people
so
don't
that
have that
means
because you are
I'm
not a
trying. I'm trying
shareholder.
to. I'm trying to understand. Like many people think that once you go into like the trading of stocks and then you buy the stocks, let's say from an online platform, you actually have rights in the company. But that's a myth. You only
You don't.
have
I mean, tell me, who do you think that bought a share of Nike on a trading platform that he uses on his phone, and he can tell the board of Nike how they should price the next
the shoe.
sneakers of Nike. Who does that? You don't do
Yeah,
that. You have no power. You
yeah. You
understand?
have no power.
Because
Yeah,
the only reason companies launch they launch IPOs or
yeah.
they launch IPOs. The only reason is because they want to raise more money from the public. That's the only reason, right? They don't want your opinion. They don't want you to say something. They just want your money. So when
How exactly do you know like how do they limit their stock? Like let's say uh, leave the stock price alone. How do they what's it called? How many stocks they actually have? How do they assess that and then come up with this is the amount of stocks we have, and this is the amount we're going to sell at this amount. The price, okay, the price is another story, but how do they determine how much stock they actually have? Yeah.
Okay, let me put it this way. I don't know how things works in Kenya, right? But in South Africa, for example, and a regular, a normal, just starting company, like if you register a company today, the less number of shares that you can give out, that you can sell, like the government on its own gives to you, is 100 shares. Okay,
Yeah.
100 shares. But now, in the process of registration of a company, you can increase the number of shares that you can sell as much as you want. Okay, so this is why sometimes some SMMEs don't know about this. You register a company and you have only 100 shares because you just take what the system has provided to you, right?
Yeah.
You get 100 shares. But those who are clever, who knows how important to have a large amount of shares when it comes to raising funds, is that they change the number of shares. They can either put 1 million to 100 million to 1 billion. Like they change that number, right? That's number one way to share to dictate how many shares you want your company to own from the registration process. Okay, so I don't know how things work in Kenya, but in South Africa, that's how you do it. You change it.
In Kenya,
You can change the shares from
1,000.
100 and you put it up. I don't know how many shares you want your company to own, or to be able to sell. Number two, you need to get a lawyer. Like, the bigger your company gets, the probability for you to own more shares. So you need to increase your shares. That's why a corporation or an enterprise, or a multi national companies, they don't have small amount of shares. They always have billion shares, because the more shares you have, the more money you can make in the public offer. And this is great because when you decide to go public, when a company starts to go public, you need to have enough shares to sell. You understand? People want to buy and buy and buy and buy and buy. It's like buying the same thing, buying the same shares, because it's now in public. Your shares are augment. You get to own more than what you could sell, or you get to sell more than what you could sell when you were a private company. But the benefit of private company is that you get to be very strategic in terms of, and selective, yes, in terms of who buys your shares. Because on the public offer, you don't have a control of who buys your shares. Anyone can buy your shares, buy 1 or 2 or 3 or 4. It's up to them. You don't control it. You see. So, but in a private company, when they are selling their shares, they can set up their own price. They don't need to set up price based on the market. They set up their own price, and they are selective on who they want to bring on board. Right, the price of a shares of a share that's being sold in a stock market, for example, almost in a stock market is based on the demand and based on the production. Like, demand, supply demand. You understand? The more requests of that shares, the higher the price goes. The less requests of shares, the lower the price goes. And based also on the economic issues, economic factors, macroeconomic factors that can affect the price of shares, to either go up or go down, and things like that. And the state of the company can also affect the price of the shares. But that is
the leadership of the company.
The leadership of the company. Many factors. Many factors. So the point, out of all this, the point is that you, as an investor, you've got to understand these three things. This aspect of investing. Your bonds. You invest in bonds. That means you are giving your money to a bank or to private or to a government or to a private company to use your money and then return your money back with an interest. That is, people do investment in bonds because they are afraid of losing money, and second, they are looking for security. Okay, for long term. Because investing on bonds, you're literally not going to lose the money. You're not losing the money. you're just protecting it. You're just keeping it for the longest term. That's all. But now, when it comes to stock market, you have a high risk of losing the value of your money. And number two, you are taking so much of risk that you don't really. There's no stability. There's no stability in terms of return on investment. Today it might go down, tomorrow it might go up. You never know. So that's how it works when it comes to stock market. But the best way of understanding this is that the stock is that you are basically buying a share so that you can own a stock. Example, again, I will give an example. You go to a tuck shop in the corner owned by a Somalian, and then you say, guys, I'm buying share I'm buying a share from your tuck shop, right?
Yeah.
I'm buying a share from your tuck shop. So how much share you gonna give? Okay, I'm gonna give you 20 shares. So 20 shares is equivalent to how many stocks in your shop? Okay, how many stocks in your shop is the 20% shares equivalent to? That's the picture, right? So if you're buying a share of Nike, it's basically Nike telling you, if 5% shares of my company of Nikes, it's equivalent to, let's say, for example, 5 sneakers. That's it. So that means that for you to get 20% profit share of from their whole revenue of Nike, they just need to sell 5 stocks. That's all. Five sneakers. Because the stock are the sneakers. The stock is not actually the shares that you see on the on what you see on the stock market is the shares that is being sold.
Oh.
Okay. The stock, what? The sneakers. You earn 5%
what you see on the market are the shares. Yeah.
Okay. Oh. So the stock is the sneakers. The share is the value which is being sold in the market. That's it. Oh. So
now I get it.
Every time they sell one sneaker, you have 100 Kenyan shilling in your pocket. So your stock are the 5 sneakers, and your value are the 20% shares. Boom, finished. Easy calculation. You're not gonna complicate yourself. And as an investor, understand that perspective. But now, if you want to go beyond just owning the 5 sneakers,
that's why they say, own one stock at a share price of 100 shillings.
Yeah.
Oh. Now I get it. Now.
So it's a very simple concept. Like, I mean, if you get this, is a very simple concept. That's what I'm saying. It's like a fooling thing, like it's like a confusing thing. Sometimes you won't get it. You won't understand. It's a very simple trick around in the stock market.
Actually, the trick comes in when now you think you're owning the company, but there's no equity in stocks and shares. That's why now you've demystified it even like way further. Like people think that once you have a stock, you own a piece of the company, but in essence, you don't really own it until you have equity in the company. That was huge. Yeah.
So if you want to own an equity in a company, you have to go directly to them, or they must come to you. They are the ones who are giving it out. You are not buying it. It's them. It's like it's you as the owner of the company. It's not like you are coming and buy a like you as an investor. I want to buy equity in this company. I mean, it doesn't happen like that. You come to buy shares. You don't come to buy equity. Equity is what they give out. And when they say we are giving out equity, this is basically them saying we are giving out power and authority. We are giving out an ability to speak, to have a say in my business. If you give us this amount of money, that's it.
If one last question now, since I think you've demystified so much in this span of time. we're going to make so many short clips of this, by the way. People have to understand. People have to understand exactly like the different rates at which bonds and stocks are usually called within the financial world. I think in the last question, as an investor in the African financial scene, what other diversifications have people overlooked, especially young people have overlooked or have gotten into that have one overlooked, shortly two overlooked, and two gotten into that have actually piqued your interest, and you could advise people to go and check out. Yeah.
I didn't get your question properly. Just try repeat it again.
You see, in the essence of diversification,
Yeah.
outside of stocks and bonds, is there another financial, let's say, like stocks and bonds, but in a different category that people have either overlooked or have gone into that has piqued your interest, and you think people should really focus on, especially the young generation of Africa, the new age investors?
I mean, investments that people overlook besides stocks and bonds. What can I say? I mean, you still have trading in commodities, for example. Investing in commodities, which is like your food, oil and gas, diamonds, minerals, and stuff like that. So those are high return and high risk. I think trading in commodities also the risk in terms of compared to stock to owning a stock or buying shares. Commodities are also the risk is balanced, depending on the economy. But in the current situation of Africa, many people would not want would be very skeptical. I wouldn't say not want, but very skeptical in investing in the commodity sector because of infrastructure deficiency, regulation, like your regulation issues in many African countries. So the commodity sector is highly regulated. I mean, there's so much of things that happens in the space that really can hinder proper movement of goods and returns on profit.
Yeah.
However, there is a huge potential. You understand? There's a huge potential in that space. If you're trading, for example, a product from Kenya to Ghana, and the product is highly in demand in Ghana, for example, from Kenya, you can make money. But remember, regulations are what's going to kill you, because if you are on ground trader and you're investing in that space, you have got to be very good with your logistics. There are high tariff barriers still in the country. Trying to bring, to make the FCFTA more effective, to allow more return on investment on that space through facilitating transportation from one country to another country, and at least have some borders that are free of tariffs or non-tariff borders. So there's a lot, and maybe provide low tariff incentives. Low tariff fee in some borders as well, to allow transportation of goods to be goods, So those are the biggest issue in the commodity investment space is regulatory concern. That's a very big issue, and that affects pricing. That affects a lot of things. Yeah. But it's a powerful space. If you've got it, I mean, you will make a lot of money in the logistics space, and as an investor, you will see high returns if you invest on that. Yeah. But I mean, now today you have apps that can also offer investment into commodities. So you can also invest through some apps, some trading apps that you can be able to invest into gold, minerals. Most of the times it's mostly trading into gold and stuff like that, and other mineral like silver and bronze. Very few of this actually in popular platforms. But if let's say now we can trade, or invest in coffee, or invest in beans, invest in rice, invest in corn,
Onions.
invest in meal, maize. There's a lot of things that you can
Yeah.
invest on, but not many platforms offer those options because of pricing, which are affected by macroeconomics issues that in Africa. So that's the concern. Now, another one that I would also say, which is being overlooked, it is real estate investment, um, opportunities. So in the real estate investment opportunities that you have, I'm not saying from the aspect of buying a house and then leasing it, um, because there is many people now who buy houses and lease it as either Airbnb or normal apartments or normal residential, long-term residential offers. But I'm talking from a perspective of lending money for property to buy properties, right? So we have more people settling in the real estate, sector. There's more people buying houses to rent it out, but there is less companies actually investing into investing in people who want to buy real estate, buy houses, right?
Yeah.
So most popular are the banks. You mostly see banks are the one who do this kind of work. They lend you money to buy property that you can maybe either sell or rent, or do commercial business. But there's no private, like many private companies that actually invest in real estate, right? Like someone can come to them and say, I have this big project and I want you guys to lend me money to buy this property because we are going to build it and do this and that. Like, there's very few companies. Most companies are companies who are buying, or most investors are investing in buying real estate and then either resell it or rent it out. So that is something that also could be looked at. The possibilities of
I think
really
I'll
great.
stop you there. I'll stop you there for now. Let me just say, like, this has been one of the most informative episodes, especially when talking about stocks and bonds, because last year I did a series that we are investing in stocks, and this time around, the fact that you've explained it so well that I think people will actually understand the difference and get to know that the difference between different types of bonds and different types of stocks. Thank you so much for your time, Mario. Guys, at the end of the day, if any of you have any questions, by the way, please, I'm going to put Lucy Mario's link on either LinkedIn or Facebook, and any questions at all, even on WhatsApp. Show me your questions. I will definitely send it to them, to send it to him. And let's keep on talking. Let's keep on engaging. Thank you so much, Lucy Mario, for your time. And hopefully we'll come back. Hopefully we'll see you again tomorrow for the next episode. Thank you so much for your time, bro.